So, first of all, was that useful? Helpful?
Yeah.
Give Chris a round of applause. Okay, questions. It can be about any topic. I mean, I'd like them to, at least some of them, to be around what we were just talking about. But if you wish to broaden the horizon, you may do so also. So, Sonia, we'll go to the back to Sonia first. Go ahead, Sonia.
One that I think is really straightforward, but that's the first mistake. So, would you recommend taking out your pension lump sum tax-free as early as possible, or is there any reason why you wouldn't do that?
Yeah, there are. And the reason is that the chances are you'll hopefully have a very long and happy life. So at the moment, you're going to get, if you're a higher rate or additional rate taxpayer, you're getting 40% or 45% tax relief on your pension contribution. So you might want to wait until your 25% lump sum is as big as possible. And the biggest figure it could be is 25% of £1,073,100. Now you might say, I'm not going to get that, but if you take out, if you've been contributing to your pension for a couple of years and that figure's £5,000, you think, well, that's not worth taking out. I might wait till that, after having all the tax relief on giving the contributions. Now I know no one knows when we're going to die, but in this scenario, I'm not actually making a gift of that, of the £250,000. I'm paying my Rob and Gwyn's tax bills. So I'm not giving it, so I don't have to worry about living 7 years because I'm going to use that to pay that. I will have the balance of 750, but the 750, if you continue working as a gift out of income, you don't have to live 7 years.
That answers your question, Sonia.
Thank you.
All right, very good. Other questions? I'll come down the front for Darren.
A few social media ads pop up with different trust ideas, obviously, in today's world with these changes. Cypriot trusts, Cayman Island trusts, anything to totally avoid, or, you know, it's never as good as it appears?
Well, I'm old enough to remember Barlow Clowes, and Barlow Clowes was an investment company in Jersey that went down the pan, and they're offering, I think, a 7% return on everyone else on your bank interest, and everyone was 3%. I remember my dad saying it looks too good to be true, and it was, and he went kaput, and everyone lost their money. I would be very, very cautious about doing stuff like that.
Yeah.
Just to add an additional thought, it's interesting because when was I knew a few people that were set up in Cyprus, and was it 2010 when they had the Cypriot tax haircut? And you might remember better than I, but they took, it was more than 50% of all bank balances that were in excess of €100,000. And I knew a few people that were very happily incorporated in Cyprus. It wasn't a trust, it were companies, but they set that up for to avoid tax in the UK with international income. So, and just to be clear, that doesn't mean that there can't be advantages or legitimate reasons to be incorporated or have structures elsewhere. But well, there's probably reasons why perhaps the Cayman Islands and other tax havens have got the reputations that they do.
Yeah.
So, yeah, very good. Ash.
Are you dealing with many clients who are thinking of going offshore? Because I read a big article, particularly the jurisdictions such as Dubai and Hong Kong, that if you take your pension and you go abroad and you do drawdown, they aren't subject to the taxation rules. So effectively, I've got my mum who's 78. We're looking at the moment, she's pretty in a similar position what my father left her in the pension. Provided we could go abroad and go to either Hong Kong or Dubai, can do that, settle there. Mum can start drawing down her pension, gifting it, as long as it doesn't affect her day-to-day life, and effectively take that out tax-free, assuming mum lives in whatever it is over the next 5-6 years. So are your clients looking at that at the moment, to going offshore? Because I've been looking into it. So there's either ones called corps, or I don't know what it's called. It's where you can take your pension offshore or go to jurisdictions which are far more tax favourable to draw down your pension.
So we've got two on the go at the moment. One where a client wants to go to Cyprus. So if for those people who don't know anything about our firm, Wilkins Southworth, we're based in Barnes. We used to act for the largest telecommunications business in St. Petersburg, Russia. I was the CFO of a company on the Vancouver Stock Exchange. We act for clients ranging from small sole traders right up to, we used to act for companies on the NASDAQ, 2 companies on the NASDAQ. We do audits out in Italy. We've done personal tax for directors of Fiat, Deutsche Bank, Ferrero Rocher. And the reason we were getting involved in Cyprus is Russia used to have the best bartering regime with Cyprus, and the best bartering regime has now transgressed to being the best double taxation treaty, which is why you see a lot of Russians in Limassol. Cyprus has got a very low rate of corporation tax. The EU have just said that they want their tax regime to tighten up, but I know Ireland's got 12.5% corporation tax. We've got a client that wants to go to Dubai as well. And in all these instances, my first thing is it's not necessarily a tax answer. So what you don't want to do is you don't want to find that you've got young children. Is Dubai the right environment for that? You've got to be very comfortable if you leave the UK. The other thing you've got to bear in mind is that from a UK point of view, if you've been resident domiciled in the UK, the inheritance tax will still last up to 10 years after leaving the UK. So it's not necessarily the panacea. You've got to plan very carefully in advance if you want to do that. But there are people who want to do that mainly for income tax reasons. But if you look at sort of someone like, for those who follow football, Ineos own just over 26% of Man United. Jim Ratcliffe used to be resident in the UK. Up to 2018 when he left, he was paying £111 million a year in income tax. You've got to bear in mind that the top 1% of taxpayers pay 28% of all the tax in the UK. And generally speaking, nearly half of this country pay no tax at all. So it's those type people have been thinking, the non-domiciled thinking of leaving, you'll see that. So sometimes you've got to be careful that the tax policies that the government is introducing don't shoot themselves in the foot, because if you've got one Jim Ratcliffe leaving, then how many normal people do you need? When I say normal people, the average salary in the UK is just under £30,000. And I think if you earn basic rate of tax, you're probably paying £2,600. Someone on a high rate tax is probably paying 21 times more tax than you. Now, if all the high rate goes, then all the tax rates have got to go up for everyone else. It's sort of, that's the tax implications of this type of policy. Because by increasing employers' NI, the example I use for the guys and girls at work is that if I've got a pub and I'm making no money anyway, and the basic rate, the minimum wage is going up, employers' NI is going up, then I want to still earn a living as the publican. So I'm just going to pass it on to everyone else, all my customers, in which case beer goes up, food goes up, in which case everyone's going to end up paying for this somewhere along the line. It's not just employers going to incur the employer's NI going from 13.8 to 15%. It's going to be passed down the line. And that's the trouble with it. And that's £40 billion. £25 billion of that is just in employers' national insurance. So for the government to say we want to have growth and productivity, unless you actually stimulate the economy, it's not going to happen. And then the problem is then they won't be able to afford the £89 billion of interest that's being incurred each year at the moment and rising by another £28 billion of loans every year for 5 years. There's just no wriggle room because our debt is 98.5% of GDP. Something has got to happen here to make it worse. Otherwise, it's going to be all implode.
Thank you, Mesh.
I do have some bad news as well, though.
Yeah.
You were saying before that for the last 30 years, everybody's been sort of focused on building this pension pot. I'm sort of maybe not a little bit behind the curve in terms of doing that. I haven't had my business for that long, but I was looking at investing quite a lot into pensions. Is that still what I should be doing, or should I be looking at other options?
Is this a personal pension or a company pension?
Well, it would be paid through the company, but
Okay.
into my own.
So say the company has a SAS scheme, then the company can get tax relief on the pension. Let's just say it's £60,000.
Yeah.
So then the company gets 25% corporation tax on the £60,000. That's 15,000. So that means they've already got inherent relief. Then it goes into your pension.
Just to be clear to make sure everybody follows Chris. So everybody so far. So if Chris's company, well, there's two Chris's now, which is not helpful. Chris's company pays the company pays £60,000 into Chris's pension. The company is now reduced its profits by £60,000, which reduces its corporation tax liability by £15,000.
That's 25% of 60,000, 15,000. So he's getting corporation tax relief on it. So it is still worth doing if you are a higher rate taxpayer or an additional rate taxpayer. So a higher rate taxpayer is someone that pays tax at 40%. That's in the tax band for just over £50,000 up to £125,000. That's 40% tax. Above that, 45% tax. And you're going to get tax relief on your pension contributions as long as broadly you earn less than about £240,000. You can put in £60,000 into a pension. And if your spouse has a salary, they can do the same. So you can get tax relief. So in that scenario, if I put £60,000 in, I could get 45% tax relief on my £60,000, and I could continue doing that. And then what happens is if I build it up to £1 million, then I get a quarter of it tax free, take it out.
Yeah. So it's still the right thing to do then.
Well, don't make yourself short for other things. If you can afford that spare money, it's one of the few things you can get tax relief on.
Yeah.
I mean,
I've got quite a lot of cash in my business. It's building up.
Okay, so you could do that. I mean, the government, one of the things that was going to happen is that next year they were going to stop, 2025, they were going to stop the EIS and VCT rules. They've been extended by 10 years to 2035, which means that if I put, say, £1 million, which is the maximum I can put into an EIS scheme, unless it's a knowledge-intensive company, I can put £2 million. So if I put £1 million in, then that means that £1 million I get 30% tax relief. So I get £300,000 off my tax bill.
Yeah.
But pensions, as opposed to ISAs or anything like that, are tax deductible. So they are still worth doing on that basis.
Yeah. If I put money in, if I put £60,000 in and I've already got some money in pensions, which I could take 25% out, in terms of tax free, can I, as I'm putting 60 grand in, let's say I do it for the next few years, can I still be taking the 25% out, or someone say,
hey, like my previous answer, I would suggest you might want to wait till your pension's got a bit bigger and then take your 25% out.
Yeah, but is it legal to do that though? If I, like I want to spend quite a lot of money on my house at the moment, so.
You only take 20. You can only do the tax-free lump sum once.
Yeah, I think you can only take it out once.
No, you can do it twice.
No?
Why?
So you'll have a crystallised and an uncrystallised pot. So it will go into what we call the crystallised pot. You take your tax-free cash and your extra contributions will go into an uncrystallised pot, which you can go back and take tax-free cash on that a bit later.
Can you do that in the SAS?
You can't sort of do it 4 times or 5 times as you need the money.
So the answer is but you've got to think that if I'm putting, say, putting money into a pension personally, I'm getting pension growth on £60,000, and it's only cost me in this scenario 55% or 60% of that figure because I'm getting tax relief on the balance.
Yeah.
So I'm getting compound growth on a much bigger figure.
Yeah.
In which case, to build the fund up,
yeah,
you'd want the compound growth.
Yeah. But you can only do it twice. You can't. I can't say.
You can do it more. You can do it. So I've had clients who've gone.
Professional financial planner, Chris.
So I've had clients who pay regular contributions into their pension pot, and then they want to do some building work.
Yeah.
So they go, right, okay, well, look, can I take 50 grand? So you go, yeah, you can take 50 grand, and then the other pot is still building up, so you can come back and take tax-free cash out of that later.
Yeah.
But as Chris has said, subject to you taking the maximum, would be 25%.
Yeah, you couldn't take 25%, but couldn't you do it multiple times over?
100%. Yeah, 100%.
Well,
the key bit is the crystallised pot and the uncrystallised pot.
Right.
And that's how the pension companies have to account for that stuff. Otherwise, they'd have no idea how much tax-free cash you're taking.
Right.
And HMRC wouldn't be very happy if they're paying too much tax free cash.
Yeah, I mean, so my far less qualified answer than the two people that have spoken before, I'd just say, well, there's a good example of things in here. Is like, you're going to have questions, and you should ask the questions. And if it were me, I'm not saying that those answers aren't correct, but I'm saying I don't know definitively. I'm definitely checking. Just because I hear one answer once from one place, I'm still going to check. And you should understand it yourself. You should absolutely understand it yourself. I'd want to be aware, because to be clear, in the past, one of the reasons I ended up working with Mr. Wilkins is because I got accounting advice, which turned out to be really bad, and HMRC didn't like it. Okay, but I go, I was a qualified accountant, ex-PwC accountant, an auditor. Doesn't matter. But I heard one opinion, really liked the story because I thought it was super efficient. Tax-wise, one was like, yeah, great, this makes sense. And it turns out they weren't right. And then I had to find a better accountant to solve the problem that the previous accountant created. Okay, so just in here, again, if you're getting lost in the weeds, Gavin, don't worry, no panic. It's like you don't need to have the answers. It's just getting you a bit more aware and able to ask the right questions. So, time for one or two more questions. I'll run over to Greg.
Chris, obviously with pensions is a real concern around inheritance tax, and I agree with you. I think so many more people are going to fall into this than they once did, and with quite modest net asset worths now. But do you think there's going to be the opportunity to put BPR investments within pensions? To ring fence some of those assets.
What are BPR investments?
Business property related.
Oh, sorry, thank you.
Why do you want to put them in a pension?
Well, I'm just thinking if you've got this £1 million BPR allowance, and that's held in, those investments are now held in the pension, you've got the ability to then shelter that from inheritance tax, have you not?
But a pension is going to be subject to inheritance tax now.
But if you're holding BPR investments in there, you've got the £1 million.
Well, I've got the £1 million anyway, haven't I? I'm going to get £1 million on BPR, and the worst case, I'm only going to pay 20%.
But if you've not get any other BPR investments externally, could you use that within your pension?
Well, if I've got BPR assets, say the AIM shares, then the AIM shares are going to be subject to.
Well, let's say you haven't got AIM shares, and let's say you haven't got anything else. You've just got the pension.
Well, no BPR.
You've got no BPR assets anywhere else.
Okay.
Do you think there's going to be the ability to hold BPR assets in a pension?
Well, if I had £1 million, then I could stick it in AIM shares and still only pay 20% tax at the worst. If I had it in a pension, I'm going to be paying 40% on the lump sum, aren't I?
Well, I'm just thinking if clients have already got assets in the pension, so they're not putting any more money in.
Well, I'd be looking to take it out and trying to spend it as soon as possible, because otherwise I'm going to probably pay 67% maximum tax on it. If I do nothing with that pension, I'm going to pay 40% on death, and someone's going to pay tax on drawdown, my beneficiaries. That's sort of a pretty big number, I think. I'd be wanting to try and think of ways of spending it.
And taking the tax with cash is the obvious way of doing things straight away.
Yeah, I'd wait. I mean, personally, I'd depending on your age in life and your what you think, but I'd rather make that number as big as possible. So I get it
to the $1 million first. Yeah,
if we can.
Yeah, I love it. Yeah, and by the way, I think if you're the smartest person in the room, you're in the wrong room. And I like having two people that are smarter than me, and I get to observe the conversation. And it's sometimes there is a right answer. Sometimes it's subject to your personal circumstances. That's why you've got to kick it round. Now, I'm going to suggest, just because it was discussed yesterday, and Chris is definitely want to ask, has anyone got LLP questions? So, Jim.
Hello, Chris. Would you mind just giving us a quick rundown of the advantages of a LLP over an LTD? Why would you do it?
Yeah. So, what sort of assets have you got in an LTD?
What assets? Well, we'd be setting up a new company. And Dan was saying that you could, if you wanted to take out, say, a £50,000 salary, you would be paying 60,000 as opposed to sort of 100,000 if you were.
Yeah. So let's say that I had a trading company. Then, if I've got, let's just say, a property in the trading company, so I've got a property here, and it doesn't matter what the property is, whether it's commercial or residential, because commercial properties used to be taxed at 20% if they're owned by me personally. Residential property owned by me personally will be taxed at 24%. Now it's still at it's both at 24%. If that commercial property is owned by a limited company, then if I sell this property and make a £1 million gain, then the company is going to pay 25% corporation tax on the gain in that property. And then I need to get the money out. So I'm going to pay dividend tax or salary to get that money out. Now, dividend tax could go up to just under 40%, and I've paid 25% there. If I own this property in my own name or an LLP, I don't pay corporation tax. So this commercial property or residential property, the gain on that is now only going to be taxed in my own name. And I know the maximum capital gains tax is 24%. In a limited company, you pay 25%, but the money's in the company. So then you've got to get it out of the company. So if I had a business, let's say I want to earn £100,000 a year, and let's say my limited company makes a profit of £100,000 a year. If it was in a limited liability partnership, and limited liability partnership, it's got the same protection of the value of incorporation. It's a company's house. One is a limited company, one is a limited liability partnership. You've still got the protection of being sued personally. That £100,000 would be taxed on me personally because an LLP is a look-through for tax. An LLP doesn't pay tax. The profits are just taxed on me if I'm say the main partner. If it's in a limited company, the limited company on that £100,000 profit is going to pay 25% corporation tax, which leaves £75,000. And then I need to take it out of the company. So I'm going to pay dividend tax or salary. And again, that will suffer income tax on top of the 25% tax that the company's already paid. So generally speaking, in that scenario, you'd want a limited liability partnership. Because a limited liability partnership also has the ability, because it's not a separate legal entity, I'm not an employee or director of a limited liability partnership because it has no shareholders, it has no, it can have employees, but I'm not an employee, I'm the partner, I'm the limited liability partner. Therefore, if there's a car in that business that I use, there's no P11D benefit in kind, which there would be if the company owned it. There's no tax on any other benefits that the company provides because it's a limited liability partnership. So therefore, it's not a benefit in kind provided to me. So therefore I can claim capital allowances on the cars. The cars are in there and tax relief is at before I pay income tax. Whereas if I've got my own car that I have personally out of the business, I'm going to pay tax before I pay for the running cost of the car. So.
Is there an advantage to then, a lot of limited companies, I know we're thinking two ways, to dissolving your limited company and creating an LP, or is that just a really dark way?
So just for the recording, it was asked, is it a daft idea or is it possible, would it make sense to dissolve if you've got a limited company, dissolve it and then create an LLP, was the question.
It sort of depends what the assets are in the business. So it could be quite expensive if you've got a property in that limited company, you sell the property and then buy it back there. But you might want to just wind this down and increase that so that you're actually increasing that income in the LLP and reducing that one. You've got to be careful you're not sort of, if you're transferring assets, you'll need a business asset transfer agreement, but there are ways to do it to make it more tax efficient.
But, and I presume in the other example you gave, if it was a service-based business, it might be that you could just gradually wind down the revenues and the costs, i.e. wind the limited company down to zero and grow or scale up an LLP.
Yeah, so then what you've got to think of the structure you need. So the best tax planning is done in advance, not in arrears. And then you've got to think, well, if I'm in this situation, you think, well, I might not start here, but how do I make it better? And then you just got to think of making it a better route to how you extract your money.
Chris, do you have lots of clients who still have their limited company and an LLP and just transition income across into this and build this up over a period of time?
For the tape, I'm getting lazy now. I'm not going around. And then I'm gonna wrap it off with this question. So the question was, Chris, do you have lots of clients who still have a limited company and also an LLP, and they just I think the words were invoice across or something equivalent to that?
So I wouldn't invoice across because you'll fall foul of there's a famous tax case. Well, only if you like reading tax cases.
Famous in your world.
In my world. But there's an accountant, and what you've got to bear in mind is accountant isn't a legally privileged word. So you can call yourself a solicitor only if you're qualified. Any of you could go out and call yourselves ABC Limited Accountants, and you don't need any qualification. No one's going to stop you. But the problem is you could end up getting sued if you don't know what you're talking about. So there's this guy that says, I've got a limited company and I've got 6 directors and they've all got Ferraris, Porsches, and the PLMD benefits in kind cost us an absolute fortune. So what are you going to do then? He said, well, what we'll do is we'll set up an LLP, and the limited liability partnership will then invoice the limited company who's got its customers. And what HMRC said is that you've got the cars there, you've got an LLP there, and you've got the same limited company there. You've just put this in the middle to avoid the benefit in kind on that. And they all got hit because it didn't work. So you got to...
It was avoidance. It was just purely for...
Yeah, because just because you put an LLP in the middle, and HMRC have gone through this, it's the same as IR35. By putting a limited company in between you're providing personal services to someone to avoid being an employee. By putting a limited company in or an LLP, you've got to think, well, what's the raison d'etre? Well, it's just to avoid the PLMD benefit in kind. Well, that structure wouldn't work. You've got to think of it clever.
So there's got to be a commercial case for that entity existing that's not just, I'm only doing this so I can get benefit on my Ferraris.
Yeah, so we had
Asking
that.
for a friend.
So we had that type scenario, and mindful of how that case fell, you want to make sure that you structure it so it wouldn't fall. And that's what you do. As long as you know the cases, then you can read it.
Good.
Sorry, particularly expensive to set up LLP?
Is it expensive to set up an LLP?
No, I mean, an LLP isn't really more expensive than a limited company. I mean, a limited company, you'd have shareholders agreements. An LLP, you have members agreements, but it's not more expensive. No. I mean,
the point is, file accounts.
But it files accounts, same as limited company, and they're broadly, the accounts will be very similar. You just want to make sure that, like I say, that when it's set up, the structure's correct. And if you haven't got the right advice on the structure, then you won't actually achieve anything, such as this example with the cars when they lost the case.
Good. I'm going to put a bow on it there. So first of all, give Chris a round of applause.